How will it feel if I tell you that there is a way you can trade the market and always bag profits? Now imagine unlocking a secret, a hidden force in the market that can guide you to consistent profit, where you can spot the perfect entry of course and make decisions with confidence. This isn't a fantasy, guys. This is the power of order blocks. These powerful price zones where institutional traders make their moves can become your trading edge if you know how to identify them. In this video, we are going to uncover the secrets behind spotting and mastering how to trade order blocks. As the ancient philosopher Sun Tzu once said, opportunities multiply as they are seized. In trading, the opportunities lies in understanding the market's true structure and seizing the right moment. Order block gives you that moment, if you know how to seize them, of course. Now, without taking much of our time, let's dive into the art of reading the market and turning the odds into our favor. Now, first, let's start by understanding what an order block is. An order block is a key area in a chart where a significant amount of capital have entered the market, typically by big banks or large institutions, often referred to as smart money. Now, since they trade with huge amount of capital, their action in the market usually causes noticeable price movement on the charts. Right? So if you notice a price moving or a price hike moving sharply from the specific area or from one specific area, either on a bullish momentum or a bearish momentum, then it could indicate that smart money have taken position. Now, the initial area where these traders the initial area where these trades are executed is known as order block. I'm going to show you what an order block is later in this video. So order blocks are categorized into two. Alright, they are categorized into two types, which are the bullish order block and the bearish order block. Now, the bullish order blocks are caused by large buy orders, while the bearish order blocks are caused by large sell orders. Now, before we can trade using order blocks, we need to know how to correctly identify them. Alright, remember in the beginning of this video, I told you that if you see price moving sharply, forming a large candle from the bull side or the bear side, alright, from a specific area, which is maybe from the bull or bear side, it could indicate large institutions stepping in and forming an order block. However, not all large candles are considered as order blocks. A significant move on the chart doesn't automatically mean that an order block is present there. Okay, so there are specific rules that determines whether an order block is valid or not. So I'll discuss 3 important rules with you after the break, so sit tight.
Are you tired of guessing your way through the crypto market? Losing trades? Missed opportunities? It doesn't have to be this way. Introducing Cash Course, a signal community where we provide real-time crypto signals tailored to help you maximize gains and minimize risks. Join our signal group and unlock daily futures trading signals for massive profits. Expert spot trading signals to stay ahead. Hot meme token signals to ride the trends. Powerful arbitrage signals to maximize earnings. Don't trade blind, trade smart with our expert insights. Join us today and take control of your financial future. Enjoy your trading journey with us.
These rules are really important as you will not be able to trade this strategy or the order block strategy if you don't know them or if you don't get these rules or get to understand these rules, right? So rule number 1 says that for a candle to be classified as an order block, it must create a gap. This gap is what some people call, or some people refer to as inefficiency. Some call it imbalance, some call it fair value gap. It goes by a lot of names, but let's see examples so you can understand better. Now on the screen, you're going to see an illustration of 2 candlestick patterns, right? And however, there's a difference between this candlestick, okay, and then this candlestick. And who can tell me the difference between this candlestick in 3 seconds? Well, the difference between this candlestick is just the wick, all right? As you can see, this last red candle here, before the order block, let me put it perfectly. This last red candle over here doesn't have a longer wick. So also, the third green candle that formed doesn't have a longer short wick, all right? So, making this place to have inefficiency, All right, in other words, making this place to have gap. So the difference between this red candle, the difference between this red candle and this green candle, all right, the space that formed between this red candle and green candle is referred to as the gap, or the inefficiency, or the imbalance. But on this second illustration right here, you're going to see that this red candle over here, right, this red candle over here, all right, has a longer wick, okay, and then this third green candle over here has a longer lower wick, and there is no gap whatsoever in between the first red candle and the third green candle, making it filled, like making it to be totally filled. All right, so there's gap on this candle, or sorry, on this candlestick pattern, and there's no gap on this candlestick pattern. All right, so what we need, or what we want to see, is that an order block must have this gap. Okay, an order block must have this gap in between its candles. All right, but if an order block doesn't have this gap, like in this example, if another block doesn't have this this inefficiency, then it is not considered, or it is no longer considered as an order block. All right, so there's the second rule. All right, so rule number 2 states that an order block needs to be unmitigated. All right, so let me go back to another chart so you can see what I'm talking about. So when I say an order block needs to be unmitigated, all right, I'm referring to a situation where certain areas on the price charts has not been touched by the candles. In simpler terms, let me make it simple for you. All right, it means that price should not come back to the area or level of the order block after the order block has been spotted. All right, so if price come back to that area, it means that price has corrected itself and all the orders placed have been filled. So in this example, you're going to see that after the gap has been formed, all right, let me draw the gap. So this is the order block. As you can see, this right here is the order block. So from the wick, all right, from the lower wick of this last candle to the upper wick of this candle here, all right, so this last green candle is our order block. So after the order block has been spotted, and then there's gap, all right, there's inefficiency right here between this place. What happened? This third candle over here has a wick. So even if it's a wick that came down and touched this order block, then this order block is considered invalid. It could be a wick, it could be a candle body. We just don't want the candle, or the third candle that's going to form, to actually go back inside the what is it called, the order block area. So let me make something clear for you. Right, so this is the order block, right, and this is the candle. This is where the wick stopped, right, and then this is the third candle. They're making this place a gap between the upper wick of the first order block candle to the lower wick of this red candle that has formed. Now this is your gap, this is your inefficiency. But then what happened? This third candle right here came right down and filled the orders and even entered into the order block, not only the gap. So this is classifying it, or this has categorized this order block as inefficient or invalid order block. All right, so now let's get to rule number 3. Now guys, I need you to pay attention to this third rule, all right, because this is the most important rule as far as I'm concerned. So the third rule states that another block must lead to a break of structure or a change of character. All right, another block must lead to a break of structure or a change of character. Now, for those of us who don't know what the break of structure is, or who have not been following our videos, our past videos, or who don't know what a change of character is, now let's quickly explain what that is. So basically, we all know that the market has something called trends, all right, and trends can simply be defined as the movement of price to the upside or to the downside with time. Now, trends are categorized into two. There are uptrends and there are downtrend. This one on the screen is an uptrend, all right, meaning that buyers are in control. So let's take this uptrend as an example, all right. So during an uptrend, the market doesn't just move straight up, all right. The market doesn't just go up like this. It has a structured way, all right. It has a structured way of making higher highs, higher lows, until it gets to a point where it's going to grab liquidity, all right, just like it formed right here. Let me illustrate for you. This is a higher high and then a higher low, and another higher high and a higher low. So when you hear a higher high and higher low, it simply means that the previous high, all right, is not as high as the new high. So in an uptrend, the previous high is not as high as the new high. So also the newer high that's going to form is going to be higher than the previous high. Now, so also the previous low is not going to be as high than the new low. All right, so it keeps getting higher as the trend is progressing. That's just what higher highs and higher lows actually mean. And on the other hand, in a downtrend, let's go to a downtrend illustration and see. So in the downtrend, the trend keeps forming a lower high and lower low, lower highs and lower lows. So what this typically means is that the previous lows, sorry, the previous high, the previous high is not as high, or sorry, is higher than the new high. All right, the previous highs are higher than the new highs. So the new highs are not as high, or should I say the new highs are lower than the previous highs. So also the new lows in the downtrend are lower than the previous low. All right, so this new low over here is lower in height than the previous low. All right, that's how it keeps progressing. New lows in the downtrend are lower than the previous low, whereas in an uptrend, the new lows are higher than the previous low, making higher lows and higher highs, while in the downtrend, the new highs are lower. That's why it's called downtrend. The new highs are lower than the previous highs. So also, the new lows are lower than the previous low. So in the market structure, like an uptrend, like the one you're seeing on the screen right now, each time the price breaks above the high, all right, if each time a new high is formed, it creates a higher high, right? And it forms what we refer to as a break of structure. That means the structure of the trend has been broken again to another new high. And we all know that the markets don't stay in an uptrend forever. At some point, the trend will change, and this shift happens when the previous low are broken in an uptrend. When the previous low are broken, leading to the formation of lower lows. Now, the break of this previous high. Sorry, the break of this previous higher low into a lower low, turning the trend into a lower lows, is what we change. What we refer to as change of character. All right, because it has changed the character of the market from an uptrend to a downtrend. Now let me illustrate this, or let me zoom it out a bit so that you get to actually see what we're talking about properly. So this is a higher high and a higher low. All right, so in this scenario, or in this situation, the market will begin to form what we refer to as break of structure. All right, these arrows right here are representing the break of structure. So at this point where the higher high stopped, and then this trend went as high as this is our break of structure. All right, where the structure of the trend broke. All right, so at the point where the market has went as high as it wants to get, all right, and then create a low. All right, create a low that went lower than the previous low, as you can see right here. Now this place is our change of character. Change of character. All right, so this is the break of structures. All right, or these are the break of structures, and this is our change of character, because it does not longer respect or obey the higher high, higher low concept that it has been going with. Now it has formed a new low that is lower than the previous low, making a change of character. So change of character happens if the trend wants to actually move from an uptrend to a downtrend, all right, or from a downtrend, all right, to an uptrend in a bearish situation. So on a bearish situation, all right, if the market is forming lower highs and lower lows, all right, lower highs, lower lows, and then it came to a point where after forming a lower low like this, instead of making a lower high that's gonna stop maybe somewhere around here and then continue going to the opposite direction, something like this, all right, it's decided to actually disrespect this region over here. All right, it decided to disrespect this lower high, forming a new high. All right, forming a new high that's going to lead to a higher low and then a higher high. Now this point right here serves as our change of character. Now this is how you can be able to spot break of structures. All right, break of structure like this and change of character like this. All right, so that's a quick overview of what a break of structure and change of character is. Now, how does all this relate to order block? For an order block to be valid, it must lead to a break of structure or a change of character. This is our third rule, right? Now, let's get into a real example. This is an order block. Let me indicate it for you to see. So, this right here is an order block, okay? This is our order block, and then we say that for an order block to be successful, or for an order block to have a validity, or for it to be a valid order block, then it must go through some certain rules. All right, and the first rule is that it must have a gap, or it must form a gap from where the order block started to the third candle. So by doing that, all we need to do is to see if there's a gap. So we draw our rectangle, all right, from the order block to the third candle, just like this. Now this is perfect. Okay, so the second rule of confirming the validity of another block is that it must not be retested. So when I say it must not be retested, it means that either of, or should I say, none of this candle over here, none of these candles over here should go below this order block to fill these orders that were executed, okay, during when the order block was formed. Okay, so there's no mitigation over here. And the third rule is that a break of structure or a change of character must occur. All right, a break of structure or a change of character must occur. Now let's see if there's really a break of structure or change of character that occurred after this order block right here has been spotted. All right, because an order block must lead to a break of structure or change of character. Now let's zoom it out a bit to see if it actually changed structure or changed character. All right, so there's a high over here. All right, let me use the cycle. There's a high over here, okay, and a low, okay, and then a lower high, since this cycle over here, or this retest over here, this one is actually lower than this one, okay, and then a lower low right here, okay, another lower high, and then a lower low. And from this point where the other block was spotted, what happened? The price actually moved up and disrespected this lower low right here, forming a new high right here. Okay, so this order block has respected all the three rules and criteria that it needs to follow to become a valid order block. Now I have three order block strategies that can take your trading journey to the next level. So we're going to discuss about it right now. Now the first strategy, okay, the first strategy that I use to trade order block is the multi-time frame candlestick confirmation. Right, so what I do is whenever I spot an order block, right, just like this, right, this is another block right here. Okay, so this is another block and it has passed the test of having a gap. As you can see, there's a gap right here. Okay, there's a gap between the order block candle and then the third candle that formed. So after having passing this test, the next thing is to wait. Okay, this is a 4 hours time frame on XRP USDT. So the next thing I have to do is to wait until price test back. Okay, let me show you what I mean. I'm gonna wait until this price hits the order block area, just like this. And when price tests back, let me show you. When price tests back and just taps, even if it's not the body of the candlestick, when price taps, filling this whole area, right, on the order block, the next thing I have to do is to go to a lower time frame, like the 15 minutes, to actually look for a bullish confirmation. All right, so typically, or should I say normally, I look for a candlestick confirmation like the bullish engulfing candlestick or the hammer or the doji, all right, or a chart pattern, all right, like the inverse head and shoulder or the double bottom, all right. So let's go to the 15-minute time frame to see if there's any significant confirmation that this place is going to go up in the long run. So assuming this place have not actually formed yet, so just assume that this area have not formed yet. So you're left with this candle, all right, only this candle that tapped into this order block area. So now let's go to the 15-minute time frame to see if there's going to be any indication of a bullish reversal. So on our lower time frame, right, this was the area, right, this was the area that touched the order block. Now what are we looking for? We're looking for any bullish indication that will make us to know if this trend is actually going to go up or not. All right, so right here, as you can see, there's what we call a fair value gap. We've made videos on that, right? So let me show you the fair value gap. Right, so we start from this red candle over here, so from the top of the red candle to the bottom of the third candle, just like this. So this is our fair value gap, and this is also an order block. Right, so This is an indication that the market wants to reverse after touching the order block on the higher time frame, which is the 4-hour time frame. All right, so after spotting this, you can just take your entry, all right here. Okay, you can just take your entry at the end of this 15-minute candlestick, so the market can actually ride up with you and you make some profit. All right, I'm going to share with you on my screen some favorable time frames and the higher time frames to actually make analysis on, and the lower time frames that you can be able to use as entry in a bit. So typically, if you're using a weekly time frame, that means if you're an investor or a long-term trader, that this weekly time frame, this 1 week time frame, is going to be where you're going to make your analysis and all that. And then the 4-hour time frame is going to be where you're going to have your entry. If you're using the daily time frame, then the 1-hour time frame is going to be used for your entry. So also if you're using the 4 hours time frame, then use the 15 minutes time frame for your entry. And if you're using the 1-hour time frame for analysis, then the 5 minutes time frame is going to be used for entry. So I know other block strategy is a little bit, long and kind of, complicated if you are not focused enough. But I would like you to watch this video or rewatch the video, and if there's any questions you have as regards to what we have discussed right now, you can be able to, talk to me via the WhatsApp via the WhatsApp link I'm going to drop on the description below. And the remaining 2 strategies on how you can be able to trade order blocks are going to be discussed in our VIP mentorship program. So if you are interested to join the VIP mentorship program, you can still talk to me on my WhatsApp link that is going to be dropped on the description below. So I hope this video helps, and I hope you have a nice day.
Missing a trade is like missing a taxi. Once the taxi leaves, the unprofitable traders go ahead and try to chase after that missed trade. While the profitable traders understand there's absolutely no point in chasing after that missed trade, because the next trade is always going to be there, right around the corner. So they might as well just wait for that. Just like how if you miss a taxi, you can just wait for the next one. There's never not going to be another taxi. All I want you to understand is a missed trade is never a lost opportunity, because there will always be another one.